So it's rivalry week in college and, for that matter, pro football this week for my teams. The Dallas Cowboys holding serve yesterday at home in their traditional Thanksgiving Day game, and then you can see my alma mater I'm wearing on my cap with their rivalry game that they have this week. Trying to avoid, was it 8 or 9 years, and I can't even keep count. It's been so many years in a row that we've lost this particular game. So that's why I've got the hat on today, supporting the alma mater. As many of you probably have some significant games this week. The market finished up the week as if a lot of people were watching these games too. So there were a few significant moves on an otherwise really quiet, bland day. So I'm gonna put those moves in context and see whether or not how much we can trust them. And then we're going to take a look at a stock that's been, and an area of the market that's been quietly doing pretty well despite the weakness in the broad market for today's trade idea. So let's go ahead and get started. Today is Friday, November the 23rd, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Alright, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see everything's still pointing lower. All four lines, in fact, are all falling. You can see falling, 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 falling. Of course, market sentiment is below 50 like it was earlier this year. Here in April, the intermediate line is making its way back down towards 20 again. Near-term line still dropped today, but still is showing a potential higher low point compared to the last one, which on the index itself is a much lower low point. So we'll see if that ends up turning into a rally back up to 2750 in this area, this high point, which is what you would target. That's the near-term high in between. The momentum line is down to an extreme low point. You can see all the extremes it's hit basically during the last couple of months. Here's the last extreme. We had another down day before we got the cluster. Here's this extreme again. Had a couple of more down days before we rallied. We had a little bit of a decline there, a couple more down days before we rally, and we have a drop now. The lowest one since this one, about as low as you can get. We'll see what that turns into next week. If you look at some of the other market forecasts, the S&P actually formed a lower low point. This is the lowest closing low point that we've had during the decline. So now we haven't fallen below that long lower shadow here on the weekly chart, right? That's where your support's going to be, 2603, the low of that period. Plus you've also got a bunch of support at 2600. So we haven't broken below that yet, but it is the lowest close, and the same thing in the Dow Jones. You can see also the lowest closing price that we've had during this decline. Not quite an oversold cluster. The S&P did get one. The Dow has not gotten an oversold cluster. Its near-term line did drop a little bit lower than the last one, though we are considerably lower on the actual index. And of course, the momentum line being where it's at. Market sentiment now below 50 on the Dow. The NASDAQ has a lower market sentiment line. You can see that the near-term line actually rallied today. So it actually bounced higher because we did not get a lower close. We got that on Monday. This would be actually on Tuesday. We got that big decline and then bounced up yesterday and then didn't drop very much today, 0.5%, smaller loss than what we got on the other two indexes. Finally, the Russell 2000, its near-term line actually jumped above 50. So higher lows with obvious lower lows on the chart, heading into a double bottom. The near-term divergence would set us up to that point. Of course, the double bottom would get us up to 1580, and the break above that would be, about 100+ point moves to the upside, up to about 1700 here. If we were going to reverse that double bottom low point, so we'll see what happens there. The Russell 2000 finally showing some relative strength compared to the S&P. Here's the weekly RSI starting to turn up higher a little bit. This is the RSI of the relative strength line, not just of the Russell 2000. And you can see the indicator hitting a low point that we've hit before earlier this year. We're bouncing back up again. The MACD is low. It's starting to moderate itself. If you were to look at this on a daily chart, let's move this to a daily chart, and let's just go to like a 1-year daily chart. 1-year daily chart, and you can see, and let's go down here to a regular MACD that we use. You can see the RSI on the daily relative strength line is up about 50 now, and you can see how the RSI is starting to make its way back above the 50-day moving average. Well, actually, this would be the let's get that'd be the 2-week moving average. Sorry, this would be the 2-week, and there's the 4-week moving average. The relative strength line working its way higher after about a week or so ago, and you can see the MACD also much higher low point compared to what we saw over here, where we have about equal low points. So we have some progress, so some bottoming formation forming on this relative strength for small caps. Small caps is no longer leading the way down. It's finding some support in this 1465 area and hasn't been able to break through that yet, and holding there with some bullish price pattern, developing bullish price pattern, may give you some opportunity for bullishness in the other indexes as well. Keep in mind that we came really dang close here on, what would that be, on Tuesday, to a cluster. Only market sentiment at 21 and the intermediate line at 22 kept it from being an oversold cluster, with all 4 lines, which we haven't had, as I mentioned on Wednesday, since October 2011. Since that point, we've had a 27% annualized return for 7 years. So that gave us an oversold condition that was quite the buying opportunity. And again, the cluster of clusters that we've gotten here is, again, we haven't had that since March of 2009. As we all know, that's been the buying opportunity of a decade, of some people's trading lifetimes that we had back then. And so, needless to say, that this decline on the Russell is giving us an opportunity that to do something with. Now, keep in mind, the October 2011 came after August and September, where we had the credit downgrade and things were really bad, and we kind of bottomed out in October. 2009, of course, came after a full year. So here we're actually coming down from all-time highs and getting this opportunity. So it's rare for us to come down so quickly from an all-time high, not necessarily from a decline that we've already had, and then giving us this kind of oversold condition. So again, a rare opportunity that we're presented with here that we just don't get very often. Okay, before we look at some other charts here, reminder to subscribe to our YouTube channel. Mouse over this Market Scholars logo right here in the bottom right corner of your video, then click that red subscribe button that pops out. Also, click the thumbs up icon down below the video. That tells me 2 things. Number 1, it tells me you got something out of the video today. Number 2, it tells me that you want me to do this video, or Brandon to do this video on Monday, and then Tuesday, and then so on. So every time you click that thumbs up icon, you're letting us know your feedback that you want us to keep doing these. A really quick way to give us that feedback, you can do that right now while you're watching. Scroll down further below and comment on anything that stood out to you from tonight's video or today's video. Join our Daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click on that link up there to subscribe to our list. Follow me on Twitter for more content like this throughout the day, and also join our Market Outlook community that we created on Facebook. Also, you can watch our Market Outlook videos on our blog at marketscholars.com. Just click blog up here. You'll see among all the other posts, usually the most recent Market Outlook post towards the top. Remember, on this page, there's a lot of other things you can do as well. You can subscribe to our site up here for free. You can continue the discussion in our forums. You have to subscribe to participate in the forums there. There's our calendar that we have for upcoming classes here next week, and of course, you can like tonight's Market Outlook tweet by clicking that heart right there, and then hit that like button. Here's the tonight's Market Outlook Facebook post. You can like and share tonight's Market Outlook there, and then there's the like button for our blog. Clicking those 3 things, again, let us know that you want us to keep doing these videos day after day. If for whatever reason you don't, then you don't have to click anything, of course. Here's what the weekly chart looks like. So again, we closed below the 200-day moving average this week on low volume. This is one of the lightest weeks of volume that we've had. Granted, 3.5 days versus 5, but even the days that we traded, very, very light volume. So take moves like this with a grain of salt when there's not a lot of volume associated with it. Once normal volume kicks in the next week with 5 full days of trading, we'll see if that break below the 200-day moving average holds. We're most likely also going to get a crossover, a death cross next week. And will that set the low point like it has before or will that be the beginning of a bear market, and not just a 20% decline like like this decline we're already getting, but a extended run below the 200-day moving average with both of them falling. In fact, if you see, the 200-day moving average actually is falling now. Of course, the 50-day moving average has been falling for a few weeks. The Russell 2000, you can see the Dow broke below the 200-day for the first time during this decline. The Nasdaq is still holding that long lower shadows low point for a close this week, and the Russell 2000 again trying to set that low point, which it usually does after the death cross. So you typically get some kind of return move up to at least the 50, if not the 200-day moving average, and then we see if that ends up being the low point, or we bounce and we start a bear market. That's kind of what we're looking for now. We've got the death cross. We're setting the low point so far as of right now. And now in this next bounce, the question is, how far up are we going to go? Are we going to get back up through and back up to these old highs, or are we just going to hit that 200-day moving average now and roll back over? Same thing with the other indexes like the S&P, which, as I mentioned before, see, the Nasdaq will most likely next week too will give us a death cross. The Dow might be another week or two later. The S&P will most likely give us that death cross next week as well. You look at the 3 green arrow chart. For the S&P, of course, you got 3 red arrows. Put it on the 2-line version. When you break out those lines, still got this big time divergence still setting up on the MACD. How far the 8-day is away from the 17. Not nearly as far here on this low point as it was over here on this low point. We really got the 8-day really did get away. And of course, as I showed you before on the MACD, when you look at the current price relative to where we are to the 30-day moving average, the blue line there. Here we go. Then you can see here again lower lows on a closing basis, at least, with much higher lows than the actual MACD. So we're a lot closer to the 30-day moving average than we were over here, even though we're to a lower low. So that's a divergence, and we'll see if that turns into any kind of bounce back opportunity. You can see the same thing on the Russell 2000, the Nasdaq Composite. Take a look at that here. There we go. Again, you can see higher lows with much obvious lower lows, but we're not as far away from the 30-day moving average on this low point, and that's the textbook definition of what a divergence is and why it's bullish. When you get the higher lows with the lower lows here, because we're not extending as far, just like we don't extend as far to the upside on the bearish divergences. Alright, when you look at today's intraday chart, you can see we gapped down, we filled in the gap initially, and then you look at the very, very low volume that we've had for most of the day today. So again, don't put a whole lot of stock into the action. We're still above the 4-week low point. In fact, here in a few days next week, this will be the 4-week low point that we've had. So we've gone from the 4-week high back to the 4-week low, just like that, actually. And you can see the purple line being the open. So this will move down into this area here next week, the open of the Hakinyashi candlestick. You have to get above that for it to be, for there to be an long upper shadow. Also, you can see the high point for this week will be right here at basically the high point of this week was right at the open of the week at 273. The low point was right at the very end of the week. So about a 10-point drop just this week alone. Still got about a 20-point drop. Not quite the 10% move that we saw over here. We had a 10% plus 10% or more on a 2-week basis. So your high point for the week is going to be right there. That's going to be where your brown line is. Of course, the dotted line is going to be there. It's going to move down a little bit more when this. Actually, it's going to move up a little bit. Sorry, it's going to move up a little bit when this low point at 259 moves up to this low point. So it's going to move up into this area more than likely. And then, of course, you'll have the purple line moving down a little bit too. So you'll see probably about 270 to 273 is where all 3 of those lines are going to be that you'd have to get through and get above for us to get back into that bullish side of things. Where now we're in the lower half of the trading range, which would make this pink, right? Which would color this pink if we did that. But of course, when you look at the volume on in the trading range, Very, very small trading range, not surprising. Half day of trading, very, very low volume, and we had low volume on Wednesday on a full day of trading, so very low volume today. And if you look at the week's worth of volume, you can see how light it was. I mean, we had very similar volume a couple of weeks ago, and that was pretty light because that was 5 full days in early November. And then you can see last week's volume, which is relatively large for SPY, not as big as the volume we saw during these initial declines. So that week and these 4 weeks in a row, we had more than 1.5 times the weekly volume, the 20-week average, almost a 6-month average there. So big declines that we've now dropped back down. Of course, putting all that volume and trading range into context. Here we go. Putting all that volume into context, you can see the 1 point some odd trading range. What was that? 1.75 with a little bit of a gap. You're looking down in this area, very low end. The volume was like 42 million shares. Even if you were to double that at 84 million, you're looking like right here. So that's still below the average. And of course, the trading ranges are not getting to that 3% mark, right? It's the 3% mark on this ATR, relative ATR, that starts the bear markets. Usually when you get that first initial volatility surge, it produces a 3% jump in this. And here we've only been able to get up to 2%, and you can see the volatility, even with today's, the last 2 days decline, the volatility got back up to 21.5, but we're still even below 1. So this last couple of days, that we've dropped to a new closing low point during this decline, big time grain of salt, because we're not getting a jump in volatility, we're not getting a lot of volume. It is a holiday week, so next week's going to tell us how much stock we should put in that decline. And of course, usually you tend to get the moves opposite of the low volume moves that you get, if they're significant at all. And this somewhat significant because it's a lower close, but if there's any kind of significance in a move on low volume, when volume kicks in, you tend to get the opposite moves. So if not initially with a knee-jerk reaction first, but ultimately with the opposite move with the full amount of volume. We'll see if that ends up being the case next week, which, again, if you look at the seasonality of things, next week tends to be a bullish week. Now, keep in mind, the last couple of weeks have been typically bullish weeks too, over the last 20 years, and of course, that hasn't been the case. The last 2 weeks, we've gone from here, 1.34% gain for the year, for the calendar year, down to a 4% loss, again, for the calendar year. We'll see if we, over this next week or two, jump back up and catch back up to where the market is by the end of the year, like we've done every other time. Now, granted, it took a little bit longer here, and it didn't take as long on this move higher, but you can see every time we've gone away from the averages, we tend to make the reverse move back up to it. Here's that end of April week where we were kind of bearish during some bullish weeks, and then during what typically is a down period for the S&P, we caught back up to the returns, the average returns. We'll see if that ends up being the case by the end of this year, starting with what is typically a bullish week next week. Alright, so to summarize, this week, very low volume move, but it's a rather significant move in the fact that we closed below the 200-day moving average. We closed at the lowest closing point on a daily and a weekly basis during this decline. But again, the fact that it wasn't associated with any significant amount of volume because of the holiday, and even on a full day's basis wasn't very much either, goes to show that we can't really trust a move on low volume until regular amounts of volume kick in. And we'll see what happens early next week when that regular volume kicks in. Expect more of a decline to test those lows on a knee-jerk basis, but where we close next week is going to be the most important factor. Even where we close out just simply on Monday is going to be the most important factor in terms of how bearish this week's move really was in hindsight. I mean, bearish enough that we almost got a rare oversold cluster on that small cap index that was such a bullish signal, and bearish enough that we've got death crosses on all the major indexes. At least we will have by next week. And what do we do now as we make return moves back to the 200-day moving average, which is typical after a death cross or a golden cross? And then do we start the bear market there? Or, you know, have we set the low point? We start 2019 with a bullish long-term run. All right, market sentiment's below 50, so the next intermediate run, you know, would start a 6 to 9 month rally. That's the expectations that we would look for if and when that were to begin again. A lot of those intermediate lines getting really close to 20, and in the past, as we've seen, even the recent past with how bearish we've been this year multiple times, it doesn't stay below 20 for very long before it turns back around again. Doesn't necessarily mean that we'll start a bullish long-term trend, but at least we'll make that return move to the back to the 200-day moving average to tell us, are we starting a bear market, or was this a fluke, a fake out move below the 200-day moving average? So what do you think about that? Do you agree? Do you disagree with the assessment we have today from our market outlook routine? Click that poll that's popping out in the top right corner of your screen and click either agree or disagree. If you click disagree, scroll down further down below into the comment section. Let us know what you're seeing that would suggest that we are a lot more bearish, that we should put a lot more trust into this week's move because of some whatever it is that you're seeing that we would love to have you share with us in our comment section with the market scholars community. All right, now let's take a look at what's driving the price action today. You know, very small numbers across the board except for one. You can see a big decline, and in crude oil today down again almost 7% after a bounce here on Wednesday. Sharp decline. You can see commodities, anything related to crude oil getting hit hard. Emerging markets also down. You can see value stocks falling more than growth stocks today. Kind of interesting development there. Dividend stocks falling more than preferred stocks there. And you can also see gold and short-term bonds up here at the top, and the dollar being the best performer. In fact, the dollar had the best week out of anybody, outpacing long-term bonds and gold. Foreign bonds down here, high yield bonds with a small loss on the week. Of course, crude oil down 11% this week alone, about 17% for 17% over the past 2 weeks. There's your decline. There's your death cross too that we got here this week. You got the dark pink shading. Big sharp declines from what, $76 up here all the way down to 50 now. You look at the market forecast for crude oil. There's your sharp decline after yesterday's bounce. All those clusters we got on the way down, close to a cluster today, 21 on the near-term line. So getting really close again. You know, still got a divergence set up here on the near-term line, so we'll see what that plays out. And of course, when you look at USO on the volume chart again, and we've been seeing this a couple of times here lately, you can see another day of about 3 times, 3 standard deviations of this of the volume this year here at 1083. Big, you know, sharp drop. Not much of a range today when it was all said and done. It was most of the range occurred overnight. But you can see even the 1.5 times the average volume has reached 3 standard deviations for the year. So big volumes. When you look at it on a weekly basis over the last 5 years, volume not as high as we've seen here in early 2016, but still more than 1.5 times the average volume. So big shakedown in volume the last couple of weeks on USO again on a short holiday week. You know, again, lots of volume. We'll see, you know, once we get back to a normal week, whether that holds or not. But if you look at like linear regression here for excuse me, it's 5C, and you look at crude oil, pull up crude oil here, you can see the S&P is back down to 2 standard deviations below. But look at crude oil, whoops, crude oil right here, here we go. You can see now with this decline, we are now down to 1 standard deviation move. You can see the ATR up to almost 5%. So big declines there, but a big move in such a small amount of time. Again, it's rare for us to make that big of a move and not get some kind of bounce again, like we saw earlier in SPX when we were 2 standard deviations down and we bounced back up. And we'll see if that ends up being the case again now that we're back down those extreme oversold levels again, without again getting up to that 3% mark. So you know, a big time grain of salt, very similar move here that we saw over here in April and ultimately in May as we led into a bullish move. So we didn't start a bear market here because the ATR didn't rise high enough. We're seeing a similar pattern right now. So when we look at the calendar for next week here really quick, we have, you know, we're really light on Monday. We have the Dallas Fed manufacturing, and then that's the last one. The Chicago Fed includes all of them. They're not really market moving, that's why you don't see anything over here. Then on Tuesday we have the Case-Shiller House Price Index, FHFA as well, and then consumer confidence. Wednesday is the big day. We have trade data coming out. We also have the GDP revision for Q3, and we'll see what happens to that original QE, you know, for the around 4% mark that we got. Yeah, 4%, 3.5% that we got on the advanced figure. New home sales as well. Petroleum report. Be interesting to see what happens there with that sharp decline in crude oil. You have FOMC minutes out on Thursday before we finish up the week. So again, typically a bullish week for equities, as we've seen, and we'll see if this GDP revision and home sales and energy reports have any kind of factor. Usually falling crude oil has a really positive benefit for consumer confidence, but a falling stock market may not. So that's going to be important revision that we're going to be watching for on Tuesday. This will just be a revision. Excuse me, no, this is the conference boards. Usually the University of Michigan's comes out. We'll see, you know, what the conference board's number, and that's also got the leading indicators. We'll take a look at that. The conference board's leading indicators index last result year over year was 6%. And again, we typically don't get the recessions until you're closer to zero, if not already through zero, as you can see on all these other charts. So we'll see, you know, what the leading indicators index looks like heading next week as well when that's released. Of course, the fear and greed index from CNN is also extremely low, down to 9, and you know it's been down here for a little bit. Here's the average, so you can see again we were down this low in 2018, and we had a decent run before that. 2016 we had this kind of decline that led to a decent move higher. We'll see if that ends up being the case again. From a sector standpoint, you can see your safe haven areas are actually up today. Staples, healthcare, utilities, industrials outperformed the S&P. Real estate also with a small outperformance. On the other end, energy stocks got hammered. They were actually holding up really well until today. You can see they were actually the second best performing sector despite the weakness in crude oil. But today's weakness in crude oil really put a lot of pressure on those energy stocks. Technology also down quite a bit too. On the other end of the spectrum, real estate and utilities, interest rate sensitive areas, you know, had a good week, relatively good week. They paced the market. Their staples as well, outpacing in healthcare too, doing relatively well compared to the S&P. Whereas some of these other areas, technology, discretionary, communication services, were your biggest losers on the week. You zoom this out to a 4-week pattern. We look at the 4-week low point. So here's 1, 2, 3, 4. And here let's change this to an hourly period. So here the S&P over the last 4 weeks, remember, you know, we're trading at the 4-week low point again. There's the 4-week low over there. That's about to come off the chart. So we're back down to about a 1% loss for the week, and technology, discretionary, communication services, energy are the sectors that are, you know, leading this decline really from, what does this be, 11.8. Let's go here to 11.8 and see during this decline that we're having, there's your, you know, your biggest losers of those 4 areas, down 8 to 10% on technology, with the S&P down 6.5. On the other end of the spectrum, real estate's flat during that time frame. I remember the S&P is down just a smidgen, so it's not really down significant either. It was up, but this is during this pullback during the 4-week period. Real estate's holding up. Utilities is only down 1.5%, so much better performance. Staples has got half the loss is what the broad market has. So you can see where, why some of these areas, especially these dividend growth payers, do really well in this type of environment, whereas these high beta names, communication services, technology, discretionary, they don't do nearly as well. They really lead the big moves to the downside. Now they'll bounce up the most to the upside if and when that occurs. Here, let's go to the 12 grid. That's what I wanted to look at here. These are ranked in order to the last sector selector rankings that we have. Brandon's working on updating it for this week. But you can see your safe havens up here at the top. They're your better performers here recently. There's communication services down close to its 3-month lows, with discretionary and technology showing an oversold cluster. Energy is at a 3-month low point. Industrial materials is off of it. Materials continues to show some relative strength. There's industrials, financials, all looking very similar to what the broad market as a whole is looking like outside of what these three. Now, on a relative basis to everywhere else in the world, keep in mind that the U.S. stocks have been down this week, but so has pretty much everything else. You can see China is not off at its lows like S&P is, and Russia is off of its 3-month lows too, though that's getting, these oversold clusters are moving off of the chart here pretty soon. Same with Brazil. But you can see here over the past week, Turkey, Indonesia are actually doing relatively well. They've been beaten up so much, they've been doing relatively well. The S&P is down here at the bottom, right, underperforming pretty much everybody for the week. There's China, and then most of your European. There's the UK, and Japan, Australia, and then there's Germany also with some outperformance. So all these areas, they're all down too. They're all showing pink charts, which are bearish postures. They're all got red moving averages, except for a few of them like China and India and Russia, right? Those emerging markets. And as I've mentioned before, if and when the market does turn around and start head higher again, it will be those emerging markets that will typically lead us, or that will lead us because of how beaten up they've been. And from a sector rotation standpoint, it's materials, energy, and industrials that will perform similar when emerging markets lead the U.S. markets. All right, so for our trade idea today, I wanted to take a look at a stock that's actually been doing okay this week. Pulte Homes had its own little kind of golden cross, in this case with the 8 and 17-day moving average crossing over the 30. You can see it made a return move back to the 30 after the golden cross before bouncing, now getting above the 8-day, moving up to new highs. MACD and stochastics bullish. There's your big significant kind of capitulation volume and subsequent volume on the bounce back up. Take a look at the Bollinger Bands, and here's this chart tells an interesting story with Pulte Homes. You had all this volume down here with all that big volume on the move and the bounce, and then the return move, as I mentioned before. But now we're breaking into this kind of area of low volume. The next layer of volume resistance is right in here to 28 to 30 in this 29 area. So there's an opportunity here to do a bullish trade to take advantage of this vacuum of volume that we can easily go through on our way to the upside up to that big volume node. You can see from a long-term perspective, PHM, breaking up above this week, up above a lot of weeks highs here. So getting above the 50-day moving average, getting above the last 1, 2, 3, 4 plus weeks high points. Very bullish close here for considering how bearish that we've been. As I mentioned before, you get that return move after the death cross. We're finally getting the return move back, in this case, through the 50-day moving average, now back up to the 200-day moving average. That blue line being a break-even point for this bullish trade, where you sell the buy the 26 call option in January, sell for $1.43, sell the 29 for 36 cents, so reduce your cost down to just $1. When you look at the reward to risk ratio, you've got about a $200 risk for $100, or $200 gain for $100 risk. So you got a 2-to-1 reward to risk ratio if with about a 30% chance of making something on this trade. So kind of like a long call option, but without the significant negative theta, and without the significant positive vega. Usually volatility declines as we rally. We're at post earnings now, so we're not going to get the rise in volatility. So you take away those two factors, which typically limit your long calls, by not just buying a call option but selling a call option where you think there might be some resistance anyway, up there in that 29 area. So even if we were to cap our gains at 29, that's okay, because there's going to be a lot of volume resistance up in this area regardless. Alright, so that wraps us up for this post-Thanksgiving holiday market outlook video on a shortened half-day, very light volume day of trading. Doesn't mean that we didn't have moves today, as there were some significant moves. The question is, how much validity do these significant moves have on a day that was only a half day of trading with light volume, generally speaking, without the full market participation that we'll get next week, along with a few things, significant items due up on the economic calendar. So we'll take some interesting patterns, interesting bottoming patterns that appear to be developing. We'll see next week, as early as Monday and Tuesday, whether or not those patterns will actually come to fruition or not. So as always, thank you very much for watching. Have a great rest of your holiday weekend, everybody. Remember to subscribe to our YouTube channel, click the thumbs up icon, and comment down below. Follow me on Twitter for more content like this. Join our Market Outlook community that we created on Facebook. Have a great day, and we'll see you all next time.